Good afternoon. This is Brian Shannon from Alpha Trends Blogspot. It is Tuesday, August 28th, 2007, and the market's closed. And we had another sell-off. The S&P 500 was down 2.2% with its $3.22 loss. And you can see that, again, I've been calling this market overall guilty till proven innocent because of the declining 50-day moving average. And we're reminded of why we have to take such a cautious stance when the 50-day moving average is declining. It doesn't mean there aren't going to be great opportunities for the long side, but those opportunities, as we've seen, come quick and they fail quick too. So you have to be very fast with your locking in your profits. And yesterday I had suggested that because of the short-term indecision in the markets here, that it looked like it was really time to get aggressive about locking in any profits that you had on long positions. And in the semiconductors, I even suggested a short sale. We saw that the market was making these lower lows, lower highs, and then just made a lower low at the end of the day. It also broke this uptrend line on the 10-minute time frame that I had pointed out, and that told us it was time to be very cautious. I was somewhat optimistic because of a rising 5-day moving average, but again, price is the only thing that pays us. Once it broke down like this and held below it, it was obvious that the sellers were taking control for today at least. Now we've got to look at this market as it's basically a trend alignment is what I like to call it. The longer term the trend on the daily time frame is down, and before we had yesterday we had indecision or stage 3 on the short-term time frame. Today we have a stage 4 downtrend, which is in alignment with the stage 4 downtrend on the daily time frame. Taking a look at Fibonacci as we did yesterday to come up with some potential price objectives where this market may decline to if it's just a bounce, if we don't get a test. And that's going to be the big question here is, does this market test the lows from a week and a half ago? We're back below the 200-day moving average. We're back below the 10, 20, and 50-day moving average. And the 10, 20, and 50-day moving averages are all heading lower. So the market supports lower prices still to come. The market did break down through the 38.2% retracement, and now it's looking like the next potential level of support. Doesn't mean that's where you ought to be buying or putting bids in, but there's the potential that the market may find support down here near this 142.75. If that fails, then you might look at the 61.8% retracement and then a test of the lows. But it is in a downtrend, so lower highs and lower lows is what defines a downtrend, so it wouldn't be surprising to see it come down and hit those lower lows. Today we had an increase in volume once again, and volume again, what we want to do is we want to measure volume on a relative basis. Not necessarily, I've got a moving average down here, and basically, you can see that all summer the volume has been expanding in this market, contrary to what most people think the volume does do or should do. And we've had exceptionally strong volume here over the last 4 weeks. Now, there's some external factors there that you can explain away, but the point is the market doesn't always do as it's expected to do. And what we want to look for is the pattern of the event and relative to the event. The most recent event is we saw a rally on declining volume. Today we saw people quickly trying to exit their long positions and add to the short side, and volume expanded once again, showing that there's more fear in this market than greed, at least from the bulls there is. It'll be interesting to see if my blog readership goes up again today. I bet you it will, because anytime the market sells off like this and there's a lot of emotion, people start searching for answers. The answers are we're in a downtrend, and right now it looks like this downtrend might have got a little extended on the short-term time frame, so maybe a bounce up towards that 145 before we continue to test the lows. But the market is guilty till proven innocent. Yesterday, the early signs came from basically the semiconductors. The semiconductors, yesterday I had said from failed moves come fast moves, and I was referring to this failed breakout here past the $37.30 level that we had been looking at. The market broke past that level on Friday. Yesterday it failed. It broke this little uptrend line on the 10-minute time frame and closed below the 5-day moving average. What I was hoping for was a little bit of strength early on, maybe up towards this level, and then to sell it short on weakness. Unfortunately, the market was weak right from the open and continued to be weak, but there were definitely clues, there were signs there that the market was weak and that the balance of power was shifting from buyers to sellers. This market has retraced more than 50% now of that recovery rally within the overall downtrend. So we're still guilty till proven innocent on the downtrend. We've got a declining 10, 20, and 50-day moving average. The market did find support of the 200-day moving average. Perhaps it'll find support in there, but that's just guessing at this point. It is not a reason to make any purchases. Guilty till proven innocent is the way you have to look at this. To try and pick a bottom is really foolish in here. The IWM, Russell 2000, what I was saying was that basically this $80.20 level, the 200-day moving average, kept finding sellers, and the market seemed to be drifting away from that level quietly as it made lower highs, but it was holding support in here, and basically I said breaking below that support. I wouldn't be surprised to see a test of the 10 and 20-day moving averages. You can see we sliced right down through those. I was looking at maybe that 78 level would be an area where the market stabilized, and that shows you that moving averages aren't a timing system or a place to get involved. They're just potential levels that other market participants focus on, so we have to be aware of any activity that unfolds near there as why would that be happening? Well, maybe it would have been the moving averages. However, price takes precedence, and when the market's declining like this, now what we have to look at is, let's take again a look at these Fibonacci levels. From that recent rally to the high, we've now retraced more than 50% of it. You can see that 50% level is about 76.65. A 2/3 retracement would be down here about 75.90. But the market remains in a downtrend, and we've got to learn not to trust these rallies. They're great for trading, but as far as trusting them and thinking they can build to something bigger and the market turns around, it does happen. But right now, for instance, in the Qs, we've got these lower highs and the lower lows. Now we'll see, are we going to make another lower low? If we don't make another lower low, well, then this level will be the important little monitor, 48.30, breaking back above there, perhaps. But that's a possibility in the future. If it is a possibility, you could look at it this way, that it's now making a right shoulder, and that right shoulder perhaps is going to come down to a level, maybe the 50 or 62% retracement level down here. At 50% retracement would be 46.30, and 61.8 would be about 45.90. And don't look at those levels too literally. They're just potential areas of support. It's like a moving average. What's better, a simple moving average or an exponential moving average? Bottom line is neither, because if you're looking at them that precisely as the exact number is where to take action, you're looking at them incorrectly. What you want to look at is a general area where the balance of power might shift from buyers to sellers. It's just a reference point to compare price to. Same with Fibonacci. It's a potential level where we find support. If the market comes down to a 61.8% retracement at 45.90-ish, then perhaps this is going to be this big inverted head and shoulders pattern I'm outlining here on the daily time frame. So let's not look for that yet, but be aware that it is a potential possibility. We have the same market dynamics in place here, where we had increasing volume on this decline, and then this rally was marked by lower volume on the way up relative to the decline. Not relative to this moving average. I'm going to just take that moving average right off. But relative to the advance, the market saw higher volume today, and that's indicative of fear and not much confidence in this market by the buyers. Can the Fed save the day again? Who knows? That's something that the bulls will hold on to as far as hope. Hope is not a good reason to be involved in the market. If you're hoping that the Fed is going to save the day, do it with out of the money options or something. If you're going to gamble. The market is about finding an edge, and right now the edge goes to the sellers in this market because we're in a downtrend.